Here's a question that's been circling precious metal circles all week. Why did silver drop over 3% last month while gold barely flinched? If you've been watching the charts, you already know February 2026 was a tale of two metals, one steady, one swinging. And understanding why that gap exists might just reshape how you think about your portfolio. Welcome back. Today we're doing a full comparative breakdown of silver versus gold heading into March 2026. We've got data, forecasts from major institutions, and a visual comparison table you'll want to screenshot. Let's get into it. Let's start with what the data actually shows. Gold came into February sitting just above $5,400 per ounce, an extraordinary level that would have seemed impossible a year ago when it was trading around $2,924. It has set dozens of all-time highs throughout 2025. Roughly averaging nearly one record per week. By January 2026, gold had surged past $5,000 for the first time before reaching an all-time high of $5,589.38. That is a gain of more than 100% in just 12 months. February didn't break that trend. Gold held relatively firm, consolidating near record territory. Silver, by contrast, had a rougher month. After a historic rally that saw it gain over 130% throughout 2025, silver entered February at elevated levels but shed approximately 3.4% over the course of the month, a meaningful pullback that highlights just how different the two metals behave. That single statistic, gold steady, silver down 3.4% monthly, tells us something important about the structural nature of each asset. And this isn't a new pattern. Analysts have long noted that silver tends to amplify gold's direction on both sides. When gold rises, silver tends to rise harder. When gold softens or stalls, silver often takes a steeper hit. One analyst put it simply: silver is likely to outperform gold on both sides of the move. If gold corrects sharply, silver's pullback could be even steeper due to its higher volatility and thinner market structure. February was a live demonstration of that. Now let's visualize what we're looking at. Here's the core comparison table. Keep this in mind as we go through forecasts. Metric, start, gold, XAU, shot silver, XAG, price, early March 2026, $5,400, 84.90 in $. Monthly change, Feb 2026. Relatively stable, down 3.4%. Annual gain, past 12 months, 100% plus, 130% plus. Volatility profile, lower, steadier, higher, more swing market size. Where Yojotenix, silver market, smaller, thinner industrial demand share, 0.5%, 160% plus. Gold to silver ratio, der aus 48.1. HISD AVG 65. JP Morgan 2026 forecast 5,400 plus. Goldman AVG 81 NATO Aussies. Metric, gold, XAU, silver, XAG. I know it's just price, early March 2026. $5,400 Oz, 84.90 is now in Oz. Monthly change, Feb 2026. Relatively stable, down 3.4%. Annual gain, past 12.9. 100% plus, 130% plus. Volatility profile, lower, steadier, higher, more swing. Market size versus each other. 10x silver market, smaller, thinner. Rug industrial demand share, 5%, more than 60%. Whilst gold to silver ratio, more than 48.1. History AVG 65. JP Morgan 2026 forecast, 3,400 plus. Goldman, over AVG $81. One number on that table stands out immediately. The gold to silver ratio currently sitting around 48, compared to a long-term historical average of roughly 65. Some analysts observe that if that ratio were to normalize toward its historical low of around 30, silver would theoretically be trading near $170 per ounce, given gold at $5,100. That's an observational data point, not a prediction, but it gives you context for why so many eyes are on silver right now. Segment 3. Why is silver so much more volatile? 430 or 630. Let's understand the mechanics behind this volatility gap because it's not random. First, market size. Silver's overall physical market is roughly 1/10 the size of gold's when you look at annual supply and demand. Even in futures markets, silver's open interest sits at about 1/5 of gold's. A smaller market means larger price swings when the same amount of capital moves in or out. Second, silver's identity crisis. Gold is primarily a monetary and investment asset. Industrial demand accounts for only about 5% of annual consumption. Silver is the opposite. Over 60% of annual silver demand comes from industrial applications: solar panels, semiconductors, AI data centers, smartphones, and more. That industrial demand makes silver's price sensitive to economic cycles, manufacturing data, and tariff policy in a way gold simply isn't. Third, liquidity dynamics. Analysts have pointed to what they call a London liquidity squeeze, thinning above-ground inventories in London and Shanghai, as a factor that has contributed to what one Goldman Sachs team described as extreme price behavior. February's 3.4% monthly dip fits squarely into that narrative. Margin liquidation, institutional short selling, and producer forward selling can all act as accelerants when sentiment shifts. So when you see silver move more dramatically than gold in a given month, you're not just watching noise, you're watching the structural reality of a smaller, more industrially exposed market respond to the same macro inputs. Segment 4. What institutions are forecasting? 6:30, 8:30. Now, let's talk about where the major institutions see these metals heading. On gold, the consensus remains broadly constructive. Goldman Sachs has a price target of $5,400 per ounce by December 2026. Bank of America has a $6,000 target. UBS has described the recent volatility as normal within a continuing structural uptrend, characterizing the current phase as mid to late stage of a bull market. The key drivers underpinning these outlooks are continued central bank accumulation, expectations of further Federal Reserve rate cuts, a softening dollar, and persistent geopolitical risk. As one Goldman note stated, they continue to see significant upside risk to their gold forecast as central banks maintain accumulation and private investors step up ETF purchases. On silver, JP Morgan Global Research projects an average price of $81 per ounce in 2026, more than double silver's average in 2025, with a potential high of $85 per ounce in Q4. That's a meaningful institutional stamp. Bank of America, while also maintaining a broadly constructive view on silver, has cautioned about potential headwinds, including reduced solar panel consumption if input costs rise substantially. UBS has taken a more cautious near-term stance on silver, noting that an asset exhibiting 60 to 120% annualized volatility requires a commensurately large expected return to justify a long position. The Silver Institute, for its part, projects global silver supply growing by 1.5% in 2026 to a decade high of over 1 billion ounces, but also notes this would mark the 6th consecutive year of a market deficit, meaning demand continues to outpace supply structurally. Physical investment in silver is forecast to rise by 20% to a 3-year high, signaling renewed retail and institutional interest. Segment 5, Portfolio Observations, purely educational, 8:30, 10:30. Now let's talk about how observers and educators in the financial space typically frame these two metals when thinking about portfolio construction. And to be clear, this is purely observational and educational. None of what follows is financial advice. What the data historically shows is that gold and silver have tended to serve somewhat different functions in a portfolio context. Gold is frequently discussed as a store of value and hedge against currency debasement. Its lower volatility and strong central bank demand give it a different risk profile from silver. Silver, because of its dual nature as both a monetary metal and an industrial commodity, tends to attract attention from two different types of investors simultaneously, which can make it more dynamic, but also more prone to sharp corrections, like the one we observed in February. Educators in this space often point to the idea that the two metals are not interchangeable, and that understanding what role each plays, rather than simply chasing the one that performed better last month, tends to result in more durable thinking. One analyst perspective frequently cited in the literature is that a disciplined, systematic allocation strategy tends to be more effective than trying to time short-term volatility. That's not advice. It's an observation about investor behavior patterns that researchers and market commentators have noted repeatedly. What's also worth observing is the concept of incremental allocation. Multiple market educators note that rather than attempting to time entry and exit precisely in a high volatility environment, looking at consistent, regular exposure as part of a broader, diversified approach is a framework many analysts discuss. Again, context, not direction. So let's pull it all together. Heading into March 2026, gold remains near historic highs at around $5,400 per ounce, supported by central bank buying, dollar weakness, and rate cut expectations. Silver had a rougher February, pulling back approximately 3.4% month over month, a reflection of its higher structural volatility and sensitivity to industrial demand dynamics. The gold to silver ratio sits below historical norms at around 48. The Silver Institute projects a 6th straight year of supply deficit, and major institutions like JP Morgan are forecasting silver averaging $81 per ounce across 2026. What happens from here depends on factors we've laid out today: Fed policy, industrial demand trends, global liquidity conditions, and the behavior of institutional and retail investors alike. What we can say with confidence is that These two metals, while often lumped together, are telling very different stories in real time. Watching both and understanding what drives the gap between them is one of the more informative ways to read where broader financial sentiment is heading. If this breakdown was useful, hit the like button and subscribe for weekly precious metals analysis. Drop your questions about silver, gold, or the ratio in the comments. We read everyone. See you in the next one.